Alright, this lesson is going to be about breakers. Yeah, this is one that a lot of you have been anticipating, a lot of you have been waiting for. And breakers, in my opinion, they're one of my favorite entry models, and they're one of when you understand breakers, you unlock a market structure within the market. The breaker is the smart money concepts trader's worst nightmare. You know, when you see something like this, right? Yeah, you know when you see something like this, high, low, high, high, and on the retracement down, what do the smart money traders look for? Break or market structure, right? Here, they look for that. Yeah, okay, we broke this high. Now on the retracement down, they're gonna look for what in this low to trade off? The order block. Yeah, that's what a lot of people look for. You'll see on Twitter, social media, a lot of people they do BOS, which stands for break of market, break of structure, and then RTO, which is return to order block. However, what will happen is this: it won't work. And now I know some of you say that, oh, a breaker is just a failed order block. D- don't don't define it like that. The breaker block is very specific because what the breaker does, it is responsible for the market structure shift. Okay? When you see the market structure shift happen, there is no way you can have a market structure shift without a breaker block in it. It's impossible. The breaker and the market structure shift go hand in hand together. Yeah? Because what is this market structure shift? We're going higher, and then when we come back down, it breaks this low. So that's our market structure shift, and that is also a breaker. The breaker is what we trade off of when there is a market structure shift. Now, how do we define a breaker? It's pretty technical, so let's type it up so that you lot can copy it to your notes, yeah? So let's say bearish breaker. How should I define it? Bearish breaker, the lowest down close candle in the most recent swing low prior to the high being run. Okay, just have this definition for here, it will make sense. So now let's look at what a breaker looks like. Yeah, a breaker looks like this. You'll have, so let's talk about a bearish breaker first. You have a market, right? You have a market and it's moving higher, retraces down. Yeah, it makes a higher high and then it makes a lower low. So back to the definition of what I said, the lowest down close candle in the most recent swing low prior to the high being run. So you look at which high was run. This high was run by this high. So you look at the low in between these two highs, which is this. This is the low, right? Then you look at what within that low? The lowest down close candle in the most recent swing low. You look at the most down close candle within that swing low. Then you anticipate the market coming here before rejecting again. This happens every single day. There has to be a breaker. When we start looking for examples, there will be a breaker. There's always a breaker because every single day there is on the lower time frames there is always a break of market structure. So this is your breaker. This is an easy example, yeah? And I want you to draw this, and within here, within this low, let's extend that out. Within this low, you're looking for the most lowest down close candle. That is what you react off of. Now, this is an easy example. You can have breakers that appear in the market like this as well, but it's all about the logic. It's all about coming back to this, yeah? So I'll show you where the misinformed people would not understand how a breaker works. So let's say we have a market moving like this. Let's move it like this, move it like this. Which one of the lows, yeah? Pause the video and I want you guys to look at the definition. Look at the definition. I want you lot to pick here which one is the breaker. Let me put this more down. Which one is the breaker that you're expecting price to trade to before reacting off again? Is it A or is it B? The lowest down close candle in the most recent swing low prior to the high being run. The answer is this low. Why is it this low? Because we're looking at the low to be attacked. When we break this high, we retrace, and then we break this high. It's this is the low that's responsible for the high being run before breaking lower. Therefore, you go to this low. You go to the low that is in between the two highs before price moving below the low. That's the breaker. It could even be more complex and it could look something like this. It could look anything like this. You see many markets that move like that. People don't understand which low it is that the breaker lies in. Remember, it's the most recent high that's run. Yeah? You look at this high. This is the last high to get run through before breaking down. So you look at the low in between that high and the high that ran it. Not this one, because on the retracement here, we didn't break that one. It was this one that we break through. So this is where your eye goes to. Bullish break is just the opposite, of course. There's nothing different. It's just the inverse of it. This is the highest up close, my bad. The highest up close candle in the most recent high prior to the low being ran. This is the bullish breaker. So it's just the opposite. You remember how we went here, like, let me go a bit lower. Remember how we went low, high, low, higher high, lower low, and then we break off here. So remember that, yeah? That's exactly how I remember the break off. It's a bearish break if you go high, low, higher high, lower low. This is just the opposite. You go low, high, lower low, higher high. This pattern right here. Remember what this looks like. Low, high, lower low. There's this one as well. This is a high, so look. This is the extended version that we're going to talk about. Remember, I showed you with the bearish break of the first example. Remember, I showed you the standard version, and then when it can get extended with many highs, it's the same thing. Low, high, low, high, low. I wouldn't call this a high. There's not enough candles. Low, high. This is the low, low, higher, high. What happens? Into this, into these three candles together, and we move higher. Market structure shift, trade off the breaker, and we move higher. Low, high, lower low, higher high, and look at that reaction. Look at that reaction. Higher high. Yeah? Those are just some examples I've sent, and the market structure shifts. Remember what I said in the start of the video, the market structure shifts. How do you trade the market structure shift? Well, I'm giving you what to look for now in the market structure shift. You're looking for the breaker. And now, a common question that this is hard, yeah? Learning breakers is hard. I'll tell you why. When you see this, your thinking is bullish, right? Your thinking is bullish. You're not going to expect that move down. That's what you think. You're not going to expect that move down. How would you know that this move is going to come down? I'll tell you how. Patience. You do not, if the market condition is bearish, yeah? If the market condition is bearish, let me go back to the euro. If the market condition is bearish and you're seeing this form, this, why would you be looking for buys in a bearish market condition? If you want context to what a bearish market condition is, you should have notes on that from the week one, chapter one. You'll see this form. So let's say this is a bearish market, yeah? Let me clear this, and let me clear this as well. So let's say we're trading down, yeah? Let's say we're trading down. Actually, I got a bad idea. Let's say we're trading, yeah? We're trading down. This is a common example. So let's look. It's a bearish market. We're coming down. Look, low, high. This high is not being challenged by this high, and we're attacking the lows, yeah? Now we come here. We're seeing this. This is internal range liquidity, yeah? If we broke this high, then it will be what? A it will be a bullish breaker. This will become the bullish breaker here. However, let's say this is our higher time frame, right? And in this high here, let's say that we wanted to see something important in that high. Let's say there was a mitigation here, because I've taught you mitigation blocks, yeah? So let's say there was a mitigation block here, yeah? That was a bearish mitigation block here. What reactions do you expect at a bearish mitigation? A bearish reaction, right? So you can expect the breaker to form at these bearish references to price, and this is what we're going to go over. Yeah, this could have been an order block, this could have been imbalance fill that needed here, a volume imbalance, this could be a mitigation block that was here, because price is sensitive to these things. Yeah, and it's likely when we retrace, what do we always retrace into? Like for example here, when we came down, we retrace into what? This gap, yeah, this imbalance here on this candle right here, and now look, price is starting to reject off of it. Yeah, that's where you anticipate bearish breakers to form. Yeah, always watch out for the breaker, and a breaker itself can be the price. You know what I sent here, right? On the Discord. This can be your trader model. In a bullish market, you're just waiting for price to retrace down, and when price retraces down into your higher time frame area that you're looking at. Yeah. So remember that GBP USD, I outlined that 4 hour area. That's our area where we're starting to look for price to start rejecting off. When we start to reject off, if it starts to become bullish again, there will always be this market structure shift. Now, whenever there's a market structure shift, there has to be a breaker. Here's a bullish breaker, and we reject off of it. That can be your model. That is one of my models, my go-to models when I see it, and that's honestly one of the models I wait for to trade. I have a live video of me trading a breaker as well, which I'm going to add with this video. Yeah, I'm going to upload them together, and it's going to help you a lot. The breaker is very confusing. It catches a lot of people off guard, but you always have to remember the higher time frame. If you are not in line with the higher time frame, you will get caught out with lower time frame breakers. This is the biggest enemy to the standard smart money concept trading. You know the smart money concept traders who just wait for a breaker structure, return to order block, trade off of it? This will do them on their ass every time. This will do them every single time. Because here, yeah, when this happens, you see when this happens, what do they call this, guys? They call that what? They call that chalk. That's what they call it. They call this a chalk, a change of character. But they don't consider the higher time frame. So when price comes up here, tags this order block or tags this mitigation, and now it's done its retracement, they think that, oh yeah, because we broke this high, we're gonna go start making new highs. So they look for the order block that's in the low, right? And then they go what? They'll have their long position somewhere like this, right? They'll have it, let's say the order box here, they'll go here, they'll put the stop loss just here, and they'll do something like that. And what happens? Price will just destroy the stop loss because you have to consider the higher time frame and you won't get caught offside with the breaker. This is the biggest thing that catches people off guard. Yeah. So now if you just look at this bit here, chop off from here, high, low, higher high, lower low, you go to the low in between the high being run before the breakdown, which is here, and you expect the trade off of. Let's look for some examples. So 1 hour you all right, cool. Here's one. High, high, low, higher high, lower low. In what? In a bearish market condition. Look, we're trading down lower. We come up. High, low, higher high, lower low. The lowest down close candle in this high. Where is it? Is it this one that's lower or is it this one? You look for this one. This isn't a low. This is just a candle here. The low has to have the green candles after it going up. That's the low because like it's the think of a low as a U, right? Like a U. The low is in the middle of that. It's the left of it is the high part and to the right of it's high as well. That's what makes it a low, right? It's the opposite for a high. Higher high, lower low. What you do, you bring that candle out to time and you'll trade it like this. I like to take the body. You can take the wick if you want, if it's like this, but preferably you want to take the body, yeah? So you'll have your trade like this and your stop. You can have it above the high if you want to be safe here. I like to put it just quite above the breaker, yeah? If there's two down candles together, then you consider those two candles together as the breaker because those two candles on a higher time frame will be one candle and you'll trade it like this. Stop loss above the breaker, so like I put it above this high because if it goes above here, it's gonna just break the high, right? And you attack whatever low makes sense for you to attack. So if we come up here, let's say this is the most recent low, right? So then we just put our stop loss here. It's a 1 to 1.5. Um, let's find another example for you guys. Alright, cool. This is a good example. You see when I said there's multiple candles like this one, yeah? High, low, higher high, lower low. You're expecting what to get traded to? This low. But there's three down candles within it, yeah? You want to take, if there's down candles that are consecutive, this could have been two down close candles. However, it happens to be three down close candles. You extend all three of them out into time, yeah? You expand them all out into time, and you'll see it. You would have got tagged in here, and you wouldn't have got to this low. Maybe it depends if you took profit on it or not. But even on the 1 hour, you wouldn't be entering on the 1 hour, right? On the 1 hour, you'll expect this reaction of this breaker. Yeah, so then if we go onto the 5 minute, for example, just try find that. Alright, cool. If we go into the 5 minute, what do we wait for? At our higher time frame breaker, we wait for what to happen? Our market structure shifts. Yeah. So then what happens here? We're coming up higher, and then what happens? We break down lower. When you see this breakdown lower, you're looking for retracements to sell. So there's this first retracement into this imbalance, and it's just every retracement here you'll sell. So you'll see how you'll use that 1 hour order block, that 1 hour breaker for your reference point for the lower time frame. That's like how I would use the daily for like if you see a breaker and we're trading up to a breaker. Let me remove all of these. Yeah. So high, low, higher high. This wick is higher than this wick. High, low, higher high, lower low. Where does your eyes go? It's these two down close candles. What happens? Price comes not too right to it, close enough though, right? Comes up to it, and we break lower, right? Again here, high, low, high, high, break down. Your eyes go to this one, doesn't come straight to it. That's why I do account for the wick of this one, and we break down lower. You want to focus on those patterns that I'm saying. Just go on the chart and say it out loud till your brain it gets engraved. Because breakers took me some time to learn as well. High for the bearish breaker is high, low, higher high, lower low, and then you look to this down close candle. This is a bearish breaker on the weekly for Bitcoin. What does it look like? High, low, higher high, lower low. Now what's happening? Yes, I know from here we retrace, yeah? That's fine. If I let me remove all these things so it's clear. We retrace here. When we break through this low, this becomes our breaker, yeah? So for example, it could look like this. It could look something like this as well. When you have your breaker, you could have the retracement here because it's very unlikely that you have that one move down, right? So high, low, higher, high. Now you got lower, high. Once you make the lower low below that, that becomes your breaker. So look at here, high, low, higher, high, and you've got this little jerk up. Come down here. When you come down here, this is your bearish breaker. It's the lowest down close candle prior to the high being run out. So this was the high that was run out by this high. The lowest down close candle was this one. You expand that out in time. And remember, everything that I teach you, every single block, breaker block, mitigation block, order block, yeah? The opening and the 50%. Why? Because the opening and the 50% is a simple algorithmic computation. If you were to code an algorithm to reject off of certain reference points in price, yeah? Because I know you guys, we have eyes, we see the breaker block, but the algorithm doesn't see candles. What does the algorithm see as? The algorithm, let's say for whatever reason, the way I see it is the algorithm, let's say it color codes this thing. It color codes this thing to say this is a breaker block and it might apply the color yellow to the breaker block, right? It has to have a reference point of where to react. Where is it going to react within the breaker? Where does it make sense to react in the breaker? If you were to code it, would you just code any react anywhere off the breaker or react off 83% of the breaker? No, you'll give it s- s- uh clear specific reaction points. And now you might be asking, well, why not just say the open? Because if it was just the open, it will be so obvious. Yeah, everyone will clock. Retail people will clock that it will be. We're just reacting off the open of these candles. We're always reacting off the open of these candles. The market's going to do it again, and it happens again, and it happens again. So you can't just have one reference point. You have to have two, or a range. Yeah, that will work better, right? A range, because then it will keep everyone guessing, and then retail won't realize. Yeah, you see what I'm saying? So the reference point is the whole body of the breaker with specific interest to the 50% and the opening. Yeah. Now, when it comes to the breaker on the higher time frames, right? You don't trade off the weekly. Yeah. When it comes to the breaker, you anticipate rejection to show that yep, the algorithm is accepting that as a bearish reference point and it tends to go lower. Then what do you do on your lower time frames? You look for a lower time frame entry model. It's very simple. Yeah. What this chapter is doing is I'm giving you the reference points. Yeah. I'm giving you the outlines of the things where price can react to. So right now you have the mitigation block and the breaker block as reference points to where price should react off. There's a few more we're going to go over. Order block imbalance. Because if you can know where price is going to react off of on your higher time frames and you get the reaction you expect, then on the lower time frame, you just need to get with in the direction of the rejection from those candles. Yeah? And if that didn't make sense, play it again. It makes full sense what I'm saying. On the higher time frames, you want to look for the rejection of these specific areas that I'm teaching you, mitigation blocks, order blocks, breaker blocks. When you get the reaction from your higher time frame at these specific price points, on your lower time frame, you want to get in a trade, yeah, that is in the direction of the rejection. So from here, when we came here, you saw the rejection. So you want to get in a trade, in a short, in a sell, in the way of the rejection, which was down. Yeah. I already gave you this example, right? This one. I was just gonna say that one again. Let's look at the DXY. Don't see one on the DXY. I just want to find a bullish example because we've gone through quite a few bearish ones, right? Alright, I think I see one here. High, lower low, higher high. So when it goes lower low, higher high, it's bullish. When it goes high, lower low, whatever, if it goes lower low at the end, then it's going to be your bearish. If it goes high high at the end, it's bullish. If it ends in the high, then it's going to be bullish because we broke the high, right? If it ends in the lower low, then it's going to be bearish because remember, low, high, lower low, higher high. Where does your eye go to? Your eye goes to the highest up close candle in the low, in the high, but prior to the low being run out. You see how the market found support at this breaker and how it lines up with the imbalance, added confluence, right? The market found support here and we traded higher. We're seeing that now we take out this high on the retracement down, find support. I'm pretty sure we tagged that order block and we move higher on the 4 hour, right? So on the 4 hour, once we react into this breaker and you see clear rejection on it, then you go onto your low time frame, 15, 5. I want you guys to avoid the 3 and the 1. Max go to 5. It's 3 and 1 is you'll get lost in it, trust me. It's easy to get lost and flustered on the low time frames. For now, stay on the 5 and the 15. 5, if anything 5. I want you guys to stay on the 15, yeah? Because it's easier to trade when it's slower. And then on the 15 minute, once you get to the breaker and you're getting a reaction off of it on the low time frame, you will enter. Now, on the lower time frames, if there's a breaker on a low time frame, then you can enter off that as well. Yeah. So for example, oh, this is a good example as well right here. What would you have? High, low, higher high. Remember I told you that you're waiting for this low to break and you're just getting this zigzag. You don't want to break like that. You want a clean break, like a candle clean, you going through it, right? So high, low, and then it's stuttering, it's just stalling here, and then breaks down here. Now your eyes go to what? These. Yeah? Your eyes go here, and then what happens? We get this whole reaction off. We get this reaction off of the breaker, and then we move down. Yes, it goes higher after, but when we get reaction or something, guys, it doesn't mean that you've caught a trend. You will just get a reaction of these areas, especially if it's a 10-minute chart. On the daily, this is significant, yeah? Because when you react off the breaker, it's likely the next, like, until there's a bullish reference point hit, so like a bullish mitigation block or something, you're going to be bearish until you get there, or until you take out a low or something of the sort. So you see again here how there's two down close candles. You want to draw both of them out because those two, it's the selling in the low that you're looking at. Yeah, it's the selling in the low before the high is being run that you're looking at. Comes it here around, it's around the 50% of the whole two blocks together, and we move down lower. That's an entry model because it's on the 10 minute. 10 minutes of for entries, higher time frames is your points of interest. That you guys call it points of interest. Yeah. So there's a lot in this video. Yeah. I'm gonna also show you the trade that I took of the breaker so you can see it in live trading. Any questions? Ask me. Just for the end of the video, this is the breaker. Bearish breaker, high, low, higher high, lower low, enter off the low between the high getting run out and the high that ran it out. Bullish breaker is uh, low, high, lower low, higher high. Now, when it gets to higher high, yeah, when it gets to higher high, it doesn't always have to be one clean move. Yeah, it can be like this: low, high, lower low. Oh, so you got low, high, lower low, and then you see this move. This could happen, or it could happen even twice. It could go here or here. It's just when you break above this high, that's what your eye goes to. Your eye goes to the high that it came from, the low. The high before you make the lower low. For the bearish one, you look at the low before making the higher high, before it gets run down. Find examples. The only way you guys are going to learn this is if you go and apply it in the charts. Yeah? Go look for examples and just literally ask me because I don't want you guys to get flustered. You got to actively look for the breakers and start with looking for the obvious ones. Yeah? Look for the obvious breakers. I'm going to post an example of a breaker, a trade I took off the breaker, so you guys will have more reference. Yeah? Watch the video after this one. Any questions? Message me. Ask in the question section, or you can ask me on Snapchat if you're not comfortable asking in front of people. And I hope you guys take care of yourselves. Take care of yourselves. Bye.